Okay, hello everyone. Thanks for having me here. So today I'm going to talk about monetary policy and reaching for income. So this is a joint work with Ken Daniel and Lorenzo Garlappi. So we know that there are two ways we can earn returns from holding assets. One is to earn current income, such as dividends and interest, and the other is to earn capital gain. And Miller and Modigliani tell us that the split between current income versus capital gain is irrelevant because money is fungible and what you should care about is total return. However, if you read the writings of financial advisors, you tend to get a very different idea. So they usually suggest investors, especially the retirees, try to live off income and do not dip into your capital. So for instance, in Forbes, one of the financial advisors writes that the only dependable way to retire and stay retired is to boost your payout so that you never have to touch your capital. And the other financial advisor even goes into detail describing how you actually live off income. So he said that you should set up two accounts. The first one is a bank account where you collect all your dividends, all your interest for daily consumptions. And the other is a brokerage account where you keep your principal saving there. And the rationale why you want to do that is that by separating the current income from your principal, it is going to erect a barrier between you and your principal. So you don't overspend and save too little. Therefore, you don't sacrifice what you want in the long term for what you want right now. So in this paper, we try to answer the following two questions. Firstly, do investors follow this rule of living off income? And second, if they do, what are the implications for portfolio choices, asset prices, and monetary policy? So specifically, we propose the following reaching for income hypothesis. We conjecture that as the Federal Reserve lowers interest rate, the income from deposits and bonds is going to drop. And therefore, for those investors who live off their portfolio income, we find that they cannot sustain their optimal level of consumption. Therefore, they may move into higher income assets, such as high dividend stocks. And the resulting demand pressure is going to drive up the prices of these assets. And as a result, monetary policy may affect investors' portfolio choices and asset prices. So our paper builds on a large body of prior literature. So in the interest of time, I cannot go through the detail. But briefly, the literature have recognized that there is this time-varying demand for dividends, but it's not clear what is the mechanism and what is the driver there. So in this paper, we show that monetary policy is an important driver of this time variation in the demand for dividends. And our paper is also related to a recent paper by Hausmark and Solomon, and their idea is that the demand for dividend may come from the fact that there are a group of investors who fail to recognize that the stock price is going to drop when they pay out dividends. And they call it the free dividend fallacy. And in contrast, our paper is based on a different mechanism. And we argue that there's a group of investors that tend to use dividends and specifically to kind of regulate their consumption and saving decisions, and they live off income. And we show that this living off income, this consumption rule, going to naturally interact with monetary policy and generate this time variation in the demand for dividends. So today I'm going to first talk about the empirical evidence supporting this reaching for income hypothesis. Then I'm going to present a theoretical model, try to understand why do investors live off income and how does monetary policy interact with this tendency and generate a time-varying demand for dividends. So our first question is, do investors live off income? So to answer this question, we're going to use the monthly stock holding data of 78,000 US households between 1991 and 1996. And this data has been used by Barbara and Odin and several other papers. So to answer this question, we follow the paper by Baker, Nagel, and Wergler to construct a marginal propensity to consume out of dividends. So let me walk you through this graph here. So on the horizontal axis, we plot the amount of dividends generated by each portfolio in each month. And in the vertical axis, we plot the amount of money this investor withdrew from their portfolio in the same month. And you see that there are two classes of investors. On the horizontal axis, we have a group of investors. When they receive the dividends, they essentially reinvest back to the portfolio. And we call them the non-withdrawers. There's also a different group of investors living up here, and when they receive the dividend income, they withdraw almost 1-for-1 from their portfolio for consumption. And we call them the withdrawers. And you may wonder what this picture is going to look like if we replace the dividend yield with capital gain. And you'll see an entirely different picture. And this just shows that there's no investors regularly withdraw their capital gain for consumption. So what are the main takeaways from these two pictures? Firstly, it shows that investors do treat dividend and capital gain differently. And indeed, there are a group of investors who regularly live off their income for consumption. And you may wonder, who are those investors? So we regress the withdrawal dummy on a set of demographic informations, and we find that the retirees and investors with low labor income are more likely to withdraw their portfolio income for consumption, which is consistent with our prior. So now, given that there's a group of investors who regularly live off their income, we're going to formally test the reaching for income hypothesis. Specifically, we conjecture that when low interest rate monetary policy reduces income from bonds and deposits, these investors may not be able to sustain their optimal level of consumption, so they reach for income by buying more high dividend paying stocks.
Just a quick clarification. When they withdraw, you know they take the cash out of the account.
Yes, yeah. So what I'm going to do here is I'm going to regress the holding of stock I in portfolio J at time t on the change of Fed fund rates, a high dividend dummy for this stock, and the interaction between these two. And we find that, indeed, a decrease in the Fed fund rates is associated with an increase in holding for high dividend paying stocks. And the effect is much stronger for the retiree sample than the non-retiree sample. And you may wonder that monetary policy may correlate with a lot of macroeconomic variables. How can you make sure that the channel of monetary policy is indeed through interest income? So to alleviate this concern, what we do is we're going to explore the cross-region variation in the local deposit rates. And the idea is inspired by Drexler Salvo Schnabel QJE paper. So the idea is that although we only have one monetary policy for the whole country, but the transmission of monetary policy into local deposit rates is different. It depends on the local concentration of the banking sector. And specifically, deposit rates in the regions with more competitive banking sector, they're going to be more sensitive to the change of Fed fund rates. So what we're going to do here is that we're going to regress the change of holding on the change of local deposit rates, a high dividend dummy, and the interaction between these two. And we find that, indeed, a decrease in the local deposit rates is associated with an increase in holding of high dividend paying stocks for those people who live in that locality. And moreover, we separate the sample to withdrawers and non-withdrawers. Remember that these withdrawers are those people who live in the 45-degree line who regularly withdraw their income for consumption. And we find that the result is entirely driven by the withdrawer sample rather than the non-withdrawer sample. And this shows that only if you live off income, you're going to reach for income when interest rate goes down. So to get a sense of economic magnitude of this phenomenon, so we look into the mutual fund flow data. So the idea is that we want to kind of see what's the mutual fund flow, flow into the different types of mutual funds when monetary policy change. Specifically, we classify funds into high-income funds and low-income funds based on the income generated by the underlying assets. And we estimate an impulse response of the fund flows to the change of Fed fund rates. So in this graph, we plot the impulse response of the flows to a 1% reduction in the Fed fund rates to the equity funds. And the red line here is inflow to the high-income equity funds, and the blue line here is in the inflow to the low-income equity funds. And you can see that following 1% reduction in the Fed fund rates, there's significant inflows into high-income equity funds, and also the economic magnitude is large as well. So the additional inflow amounts to 5% asset under management after 3 years. We also find similar patterns for bond funds and balance funds. And also when we separate the share classes into retail share classes and institutional share classes, and we find that this fund flow is mainly driven by the retail investors rather than the institutional investors. And this suggests that this is more likely to be related to this leaving of income kind of pattern for the retail investors rather than some institutional frictions or some risk factors which are going to be targeted by the institutional investors. And we show that this effect is robust in controlling fund risk, the exposure to various risk factors, the taxes on dividends and capital gain, and the term spread. Furthermore, we use an alternative way to classify funds to high-income versus low-income funds. Before, we just use the income yield. And in the data, we find about 10% of funds, they actually try to seek to generate a higher income. For instance, there's this fund called Federated Strategic Value Dividend Fund. If you read its prospectus, it's going to tell you that the goal of this fund is try to beat the market, not in terms of total return, but in terms of income yield. Quite weird. But this is actually quite common. And the reason is that they want to cater to this income-seeking investors. So what we do here is that we're going to classify a fund as a high-income fund if the name contains dividend, income, or yield. And we also find that based on this alternative classification, following a 1% reduction in the Fed fund rates, there's this persistent inflows into these high-income funds. Lastly, we want to explore the asset pricing implication of this reaching for income behavior. And we conjecture that as more flows into the high-income funds, as more investors want to buy these high dividend-paying stocks when interest goes down, these high dividend-paying stocks should outperform the low dividend-paying stocks. So what we do here is we estimate the Fama French 5-factor alpha conditional on the past trend of monetary policy for each of these 10 dividend portfolios. So the red dot here are the Fama French 5-factor alphas when interest rates are declining, and the black dot here are the alphas when interests are rising. Okay? And you can see that when interests are declining, this high dividend portfolio is going to outperform the low dividend paying portfolios. Whereas when interests are rising, the opposite happens. The high dividend portfolios actually underperform. And this pattern inspires a trading strategy, which we're going to long these high dividend portfolios and short the low dividend paying portfolios when interests are declining, and reverse the position when interests are rising. And this dividend strategy generates a cumulative return that is comparable to the high minus low and small minus big strategy. So now I have already talked about the empirical evidence suggests that first, investors do seem to live off income, and also monetary policy do drives their demand for high dividend paying stocks. Now I'm going to present a theoretical model trying to answer the following two questions. Firstly, why do investors live off income? What they are trying to achieve there? And secondly, how does monetary policy interact with this consumption rule and change the portfolio choices and asset prices? So before I present the model, let me flash back to the quote of the financial advisor. So when they suggest investors to live off income, what they have in mind is that investors tend to spend too much and save too little. And therefore, it makes sense to put your principal savings in a relatively illiquid account, such as your brokerage account or your retirement trust, whereas commit to only consume the current income. So the typical example they have in mind is that, for example, if you go on a shopping spree on the Black Friday and you find that your money is locked into a retirement account, so you cannot get your hands on it. So this small inconvenience is going to nudge you towards saving more and spending less. So we're going to try to capture this idea. So what we're going to do is we're going to use a hyperbolic discounting preference in the behavioral economics literature. So this hyperbolic discounting is going to be represented by this beta parameter, which is the present bias. This present bias captures the tendency to overvalue immediate rewards at the expense of long-term intentions. So how does that work? Let me give you an example. So suppose now I'm getting rid of all the uncertainty in the returns. So essentially, these investors have perfect foresight. So he can essentially plan what they're going to consume in the future. Okay? So here, we are standing at time 0, right? And we know that our time discount factor from 0 to 1 is beta delta because we are subject to the present bias. I'm very impatient right now. I'm going to consume $1.2. But our discount factor is going to become delta in the future because it's not the present. So in the future, I plan to consume less. I'm going to only consume $1 and save the rest. Now, when the future comes and time 1 becomes the present, again, I'm subject to the present bias again, so my time discount factor becomes beta delta again instead of delta. So instead of consuming just $1 as I planned yesterday, I end up consuming $1.2 right now. And therefore, this hyperbolic discounting is going to generate this time inconsistent overconsumption problem. So in presence of this time inconsistency and overconsumption problem, commitment may become valuable. So in the model, we assume that this agent can put their principal in a relatively illiquid account, and then they direct the dividends and interest to a liquid bank account so that they can live off income and never dip into capital. So what they're going to do is that we're going to assume that the current consumption is going to be bounded by the current income generated by the portfolio. And notice that this current income is going to be determined by the portfolio choices in the previous period, which means that the past self can use this portfolio choice to discipline the present self not to spend too much. However, there's not obvious whether such rule is optimal because on one hand, it's going to curb this ex post overconsumption problem, but on the other hand, it's going to limit flexibility. And what if you really want to consume, but you can't? So in the model, we derive the optimal condition under which this agent is going to choose to commit to this consumption rule. We show that when the time inconsistency is very severe, which means that the beta is very low, then the commitment is utility improving. Whereas when the portfolio returns are very volatile, which means that sigma of this return is really high, then commitment can actually become utility decreasing. And then after we provide a micro foundation to this consumption rule of living off income, we're going to embed that into a general equilibrium effect framework to analyze what is the effect for asset prices. So what we're going to do here is that in the general equilibrium model, we're going to have 3 assets. We're going to have 2 stocks, one with high dividends, one with low dividend, but the total return and the risk is exactly the same. So in a Morgan-Miller world, you're going to essentially treat these 2 stocks as identical. And the third asset is a short-term bonds. And the monetary policy here is going to determine the nominal interest rate. So in this model, there's no other nominal rigidity such as sticky prices. So in absence of any friction like the income constraint, when monetary policy changes the nominal interest rate, the real rates will not change. The portfolio holdings will not change. The only thing going to change is the inflation going to flexibly adjust to the nominal interest rate. So there are going to be 2 agents, A and B, and agent A is going to suffer to the present bias. So we're going to choose to commit to an income constraint, which means that the consumption is going to be bounded by the income generated by the bonds, the low dividend paying stocks, and the high dividend paying stocks. Whereas agent B is not subject to the income constraint. So now let me show you the prediction of the model. So in this graph, I plot the portfolio holding of this agent A for each level of nominal interest rate. The blue line here is the equilibrium portfolio holding when this agent is not subject to income constraint. You can see that he's going to hold exactly the same amount of high dividend stocks and low dividend paying stocks. The reason is that these 2 stocks have exactly the same risk-return trade-off. And essentially, this is the Modigliani-Miller world when the only thing you care about is total return rather than how you split between dividend yield and capital gain. And moreover, when interest rate change, the portfolio holding stay constant. And in this economy, monetary policy is entirely neutral. So there's no real effect of monetary policy. So now the red line here plots the equilibrium when this agent is actually subject to this income constraint. And you can see that immediately going to demand higher amount of these high dividend stocks. And more interestingly, when the interest goes down, the demand for high dividend paying stocks is going to go up. So this is essentially this reaching for income behavior. Whereas the demand for the low dividend stocks first go down and then go up. And the reason why it later go up is that when the interests are very low, and these low dividend paying stocks actually become attractive. So in this graph, I plot the asset pricing implication of this model. So here we construct a dividend premium, which is measured as the ratio of risk premium of the low dividend stocks and high dividend stocks. And again, the blue line here is the equilibrium when this agent is not subject to the income constraint. And you can see that the dividend premium is essentially zero. These two stocks are going to be treated exactly at the same, with the same price. Now, when this agent is subject to income constraint, you can see that the high dividend stocks are going to be treated at a premium. And more importantly, when interest rate goes down, the dividend premium is going to go up, so which is also consistent with what we see in the data. So lastly, I want to discuss the implication of this reaching for income behavior. So firstly, we show that by changing the demand for income-generating assets, monetary policy may lead to capital reallocations across firms with different payout policies. For instance, when interests are very low, those high dividend-paying stocks may find it's cheaper to raise capital, whereas when interests are high, those low dividend-paying stocks, those low dividend-paying companies may find it's relatively cheaper to raise capital. And also we find that some firms may cater to these income-seeking investors by issuing cash dividends when interests are low. So in this graph, the blue line here, we plot the fraction of compute staff firms which initiates the cash dividends for a given year. And the red line here is the level of Fed fund rates. As you can see that when interest goes down, the firms are more likely to initiate cash dividends. However, you don't see the same patterns for share repurchases, which is a very similar way to pay out your cash. And the reason is that when firms conduct share repurchases, the investors benefit from capital gain, not the cash dividends. Lastly, another implication of this reaching for income behavior is that low interest rate monetary policy may actually lead to excessive risk taking. And the reason is that when interests are very low, bonds becomes less attractive, so investors move into equity, which depresses the risk premium. And here, this prediction that low interest rate leads to more risk taking is very similar to a reaching for yield hypothesis. But let me emphasize here, the mechanism is quite different. Based on our reaching for income hypothesis, investors take more risk to boost the current income. Whereas based on the reaching for yield hypothesis, investors take more risk to increase total returns. So let me conclude here. So in this paper, we proposed and tested this reaching for income hypothesis, the idea that low interest rate monetary policy is going to increase investors' demand for current income. And we show that this tendency to reach for income is related to the consumption and saving decisions of these investors. And next, we propose a theoretical model which shows that this living off income and never dip into capital is a self-control device for a time-inconsistent agent. And we show that monetary policy, by changing the interest income from bonds and deposits, they're going to generate this time-varying demand for dividends. Thank you so much for your attention.